That can feel like a never-ending treadmill. You are paying and paying, but never getting ahead. But what if I told you there is a way to pay off your debt faster while building wealth at the same time? It is called debt recycling, and it is a game changer. In this video, I will show how to turn your bad debts into good debts and how the wealthy use this strategy to their advantage and how you can do the same. Hi, my name is Eric Lee. I'm a chartered accountant and a real estate agent. I talk about property investment and tax strategies to help people to build wealth through property investments while saving tax and protecting their valuable assets at the same time. Okay, let's dive into today's topic. When people think about debts, it is bad. But I can tell you that not all debts are the same, because some debts can actually help you to make money. I actually covered the topic why you should use debt wisely rather than focusing on payoff. If you want to watch it, there's a link, should be here or there. Firstly, let's see what is the bad debt. Bad debt is any debt that doesn't generate income. These are the debts that cost you money and should be paid off as soon as possible. A classic example is a credit card. If you're swiping your card for shopping, holidays, or daily expenses and not paying it off in full, that's bad debt. Because you're paying high interest for something that doesn't make you money. And there is your home loan, which is a bad debt. I know it is controversial, but financially speaking, it actually is bad debt because it doesn't bring in any income. It is money going out, not coming in. That's why Robert Kiyosaki said your home is a liability. And I agree to a certain extent because your home is taking money out of your pocket, not bringing money into your pocket. However, I don't actually believe that your home is a liability because you can take the equity out and use it to buy income producing assets like investment properties, which generate income and also build the future wealth. And the other important characteristic of bad debt is the interest on the bad debt is not tax deductible because it was not used for income producing activity. Unfortunately, the interest on those bad debts are lost once paid. Now let's talk about the good debt. Good debt is the debt help you to build wealth and generate income. For example, taking out a loan to buy an investment property is a good debt because the property can generate rental income while growing in value. And the interest on the good debt is tax deductible, as you took out the debt to produce income such as rent. See the difference? Basically, money borrowed for personal enjoyment is bad debt, whereas money borrowed to be invested in income-producing asset is good debt. Now, we understand the difference between bad debt and good debt, and now let's look at how you can actually pay off your debt faster. The strategy I'm going to explain is called debt recycling, and it is all about turning bad debts into good debts. Let's say you own a family home with $500,000 debt and have $100,000 equity. The equity here refers to the amount that your bank is happy to lend you more on top of your current balance as the value of your home has increased and your income is high enough to service the loan. This equity is not yet a loan, simply because it hasn't been drawn out yet. If you do nothing with equity, it will be just sitting there doing nothing. However, instead of just letting the equity sit there, you can take it out and buy an investment property. Now you use $100,000 to purchase an income producing asset. Although it came from your home loan, this $100,000 is considered to be an investment loan for tax purposes. So it is now tax deductible, the good debt. And this is the first step of debt recycling, which is creating a good debt instead of bad debt. Then, what you do is forward all the surplus cash flow generated from the investment property into your home loan. I know you may not have any surplus cash flow, especially at earlier stage of an investment. But if you invested in the right properties, eventually it will be positively geared, either in a way that your property value and rental income increase, or you may own a property that gives you sizable depreciation, so you have a quite substantial tax savings that you can put towards to your home loan. What you're doing here is that you are paying down the bad debts, and at the same time, you are creating more equity in your home. Then, you can take the equity out again to purchase the next investment property and rinse and repeat. Eventually, you have no bad debt left, and this means that technically you have paid off your home loan. Because you've been using additional cash flows generated from multiple investment properties, it will take a lot shorter than 30 years to pay off your home loan. And the beauty is that you have not only paid off your home loan, but accumulated substantial wealth through income producing assets, in this case properties, over the years. How great! As you have watched this far, I would like to give you one final tip. You can fast track this process even more by using interest-only loans. With interest-only loans, your repayment will be lower and it frees up your cash flow, and you can use this to pay down your home loan quicker. So while you are keeping the same loan balances for your investment properties, of which the interest is tax deductible, you pay down your home loan of which the interest is not tax deductible. So you're maximizing your tax benefit here. I'm sure that you can now implement this strategy to pay off your home loan faster and also build wealth along the way. But if you need assistance to review your situations, to build plans and strategies in your property investment journey, in terms of tax and lending strategies, asset protection, and choosing the right investment properties, contact us using the details in the description below. If you found this video useful, hit the subscribe and like button and drop a comment below. I will see you in the next video.